Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Private credit is evolving. After a boom in this space in recent years, there's now a rise in co-lending, where private credit providers are partnering with specialised lenders, catering to people who aren't getting capital from traditional places like banks. MA Financial, which is a great supporter of this podcast, recently signed a $1.7 billion joint venture with US direct lender Monroe Capital and Japanese bank SMBC, Sumitomo Mitsui Banking Corporation. Frank Danieli is Managing Director, Head of Global Credit Solutions at MA Financial. Frank, welcome back to Fear and Greed.
Sean, good to be back.
And Christian Sampson is Investment Director, Global Credit Solutions at MA Financial. He joins us from New York. Christian, good morning.
Thanks, Sean. Nice to be here.
First up, co-lending. How does it work? Maybe I'll go to you, Frank, on that one.
Yeah, well, Sean, look, we've always thought that partnership is going to be the next evolution of private credit. What happens when you partner in the world of lending is that you bring together the best of loan origination, underwriting capabilities, and then portfolio management discipline. You bring this together with some really aligned parties, and that's what partnership is all about. This is a really big step change, we think, because to date, the rhetoric in private credit has all been about these new asset managers stealing share from banks, and that's actually just not true. There's some things that banks are really good at, there's some things they aren't at, and there's some ways that we can actually partner together, and that's what a venture like this one that we've done with Monroe Capital and SMBC, but other partnerships that we've done as well in the past, including here in Australia, reflect.
Okay, you talk about kind of the next step in private credit. Are you saying because there are more parties coming to the table, in a sense, suddenly private credit will become a lot more, I'm going to say flexible, that's probably the wrong word, but robust might be a better word in terms of what it can do?
I think the ambit of what it can do will continue to expand. And that's what this sort of thing reflects. The world of lending is huge. You know, this is at its best the financing of just the real world economy. And that doesn't matter if it's financing companies like we're doing with this particular partnership over in the US, mid-market companies, or whether it's home loans, car loans, asset finance, business loans. It's just the real world economy. Most businesses, your own, the listeners here, they need finance in many different ways. That finance needs to be provided for them. How that can happen is with a specialist lender, a bank, and an asset manager all working together. And I think that's a path that we'll see more and more of.
Okay, Christian, take me through the JV with Monroe Capital and SMBC, which, of course, Sumitomo Mitsui Banking Corporation, Japanese corporation. What's it mean, and what type of borrowers are you targeting through this model?
So, Sean, we did a lot of work in the US market in corporate lending. And what came out of that is middle market and companies ranging from 10 mil to 50 mil of EBITDA are the most attractive part of the market. These are real world US companies servicing other US businesses and consumers. These loans feature covenants in the form of leverage ratios and strong downside protection for lenders. So we really think that this co-lending structure provides our investors unique access to the most attractive part of the corporate lending market, being the middle market.
And the US obviously is a lot bigger than anywhere else in the world, particularly Australia. Are there sectors, are there geographies? I mean, how do you think about it?
So the market's very large, so a 10 mil to a 50 mil EBITDA is really deemed the lower middle market and the core middle market. And these companies range up to 300, 500 million of EBITDA. So we're really targeting the area of credit, which is, downside protected, where we have significant lender protections available, and it provides our investors with that downside protection.
I tell you, I was actually just over there. I landed yesterday, and everything's bigger. The cars are bigger, food's bigger, side of fries larger. It's like that. But it's even like that in the world of lending. That's also why partnership works really well. It's a really efficient way, especially as an asset manager, for us to get access to really attractive parts of the market, working with specialists in a particular space, or in the case of like an SMBC, a really established global bank with a really good US franchise that we can partner up with and just provide capital out there in the world that makes sense for us and our funds.
And when you think about the partners being Monroe and SMBC, so Monroe is a very established and actually the largest lower middle market originator of loans in the US. They have a huge origination engine, offices all over the US, a team of 30 originators, all looking at loan opportunities. They look at in excess of 3,000 loans a year and generally execute on 100 to 200. So this really provides us with a unique access to, a large funnel of origination opportunities for our investor base.
Frank, Christian, stay with me. We'll be back in a minute. My guests this morning are Frank Danieli and Christian Sampson from MA Financial. Before the break, we were talking about how it works and why you're working with Monroe, what they're bringing to the party. And Frank, you were talking about SMBC, what it brings to the party. I'm just kind of interested whether we can take any lessons from what you're doing in the US for the local market, because we talk a lot about private credit, but we don't talk about these sorts of JVs very much. Is that where the local market's going, Frank?
I think it is, Sean. We in fact, it's funny, this type of partnership is really applying something we call asset-backed lending technology to the world of, in this case, corporate loans. And Australia, I think, actually has some of the world-leading financial infrastructure around asset-backed lending. It's been happening here for many years and been happening in a really good way, good structures with good performance. I raise that because, in fact, we have actually done a $300 million credit-related partnership back in the end of 2021 with one of the major Australian banks, one of the big four. So, we've been believing that this partnership model is going to be the next evolution for a while. We did a $1 billion forward flow transaction, a similar style structure with Flexi Commercial, which is a subsidiary of Hum, last year. So we've really been pushing this partnership model forward here in Australia. And we do see a world where the Australian market evolves in a sort of step change towards these structures in private lending.
Tell me, on both sides of the private lending transaction or private credit transaction, those providing the funds and those actually receiving the funds, why is this good for those providing the funds, your investors?
Yeah, well, we've always tried to deliver our investors a very differentiated and proprietary set of lending opportunities. And if you think about the nature of partnerships, let's take back a couple of years ago, the partnership we did with that major Australian bank. Those loans that we partnered up to finance, they were in the world of medical asset finance. Those loans are not available. You just cannot go and get them anywhere else. They're otherwise sitting on the balance sheet of a bank. The only way to get exposure to them would be, I don't know, buy a bank bond or maybe have some deposits. This provides direct access to that cohort of lending. We thought it was really attractive, and that was a very well-performing portfolio for us for many years. I think this will be the same. You can't go and get these loans. If you think about some of what we're partnering up here, the nature of what we're getting exposure to is not widely available. This is co-lending. So we're out there with our partners lending together in partnership. We're making credit decisions about what we do and don't want, consistent with our framework of lending and underwriting, and then providing that finance out there. So really, although it's a partnership, the partnership model is quite proprietary, and that's what investors get access to. It's something you can't get any other way. And
then on the other side of it, if I'm receiving the money, obviously I'm getting access to funds which I may not have gotten otherwise.
Well, Christian, you're on the ground, so
that's exactly right. So we think about this as providing, in the middle market, we're providing private equity sponsors with, flexible capital available via banks and non-bank lenders in the market. So we're providing a meaningful amount of capital. We have $1.7 billion, and we're really looking to provide borrowers with flexible capital, a quick turnaround, as well as, a collaborative approach to lending.
I'm just interested, co-lending, how much do you lend? I mean, I'm sure it's deal by deal, and I'm sure there's all sorts of nuts and bolts on it, but broadly, Christian, how much do you lend as a proportion of the total loan?
So it really depends. Generally, we're lending, a material portion of the loan alongside Monroe and SMBC. And why we like that is it creates this really nice alignment of interest between our co-lending partners. We're all in it together, and this vehicle will lend alongside them, providing them with additional capital to service private equity sponsors in the US market.
Frank, we're going to see lots more of this in the next 10 years?
I think that this will be really an enormous paradigm shift in private lending. You've already seen JP Morgan come out globally and say they're going to commit, well, they're committing $50 billion of their balance sheet towards private credit, but they see $15 billion of co-lending opportunities. You've seen other banks talk about it in the order of single digits or tens of billions of dollars of opportunity. This is really significant. And if you just think about the amount of lending that's done out there in the real world by banks, not just we're doing this for middle market private equity, but if you think about the whole spectrum of everything that's on a bank balance sheet, this is a way where asset managers can partner up and access that. It's really exciting.
Frank, Christian, thank you for talking to Fear and Greed.
Thanks, Sean. It's been great.
Thanks, Sean.
That was Frank Danieli and Christian Sampson from MA Financial, a great supporter of this podcast. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.